IBM was once the most important technology company in the world. For decades, it defined the future of computing. Today, many investors barely talk about it. The cloud revolution happened. Artificial intelligence exploded. New technology giants emerged. And IBM seemed to fade into the background. For many investors, the conclusion is obvious. The story is over. IBM is simply too old, too slow, and no longer relevant. But what if that assumption is wrong? What if the market is looking at the wrong IBM? Not the IBM that sold personal computers. Not the IBM remembered for missed opportunities. But the IBM quietly rebuilding itself around hybrid cloud, enterprise AI, and some of the deepest customer relationships in technology. Because while investors chase the newest AI winners, IBM continues serving many of the world's largest banks, governments, and corporations. It continues generating billions of dollars in cash flow. And it continues positioning itself at the center of some of the most critical technology infrastructure on Earth. So here's the real question. Did the market correctly give up on IBM? Or is one of the most forgotten giants in technology quietly preparing for a comeback? And if that comeback succeeds, the market may have made a very expensive mistake. Let's find out. Before Microsoft became a software empire. Before Google became the gateway to the internet. Before Nvidia became the face of artificial intelligence. There was IBM. For generations, IBM stood at the center of the technology industry. Its systems helped process financial transactions, manage government operations, and support some of the world's largest organizations. At a time when computers were still transforming from scientific machines into business tools, IBM was already shaping how enterprises use technology. The company's influence extended far beyond its products. IBM helped establish standards, develop technologies, and train generations of engineers who would go on to shape the modern computing industry. Its reputation became so powerful that for many businesses, choosing IBM wasn't simply a technology decision. It was a statement of trust. A statement of reliability. A statement of long-term stability. This dominance earned IBM a nickname that became known around the world. Big Blue. For decades, IBM represented the gold standard of enterprise technology. Few companies commanded more respect. Few companies possessed greater influence. And few companies seemed more deeply embedded in the infrastructure of the global economy. From banks and airlines to governments and multinational corporations, IBM became part of the foundation on which modern business was built. At its peak, IBM wasn't merely one of the largest technology companies in the world. It was one of the most important. But in technology, dominance is never permanent. And the forces that create industry leaders often create the conditions for their eventual decline. For decades, IBM's size was one of its greatest strengths. Its scale. Its reputation. Its deep relationships with enterprise customers. Together, they helped make IBM one of the most successful technology companies in history. But the very qualities that made IBM successful also made it difficult to change. As technology evolved, the industry began moving faster. New competitors emerged. New business models appeared. And entirely new markets were created. The shift began with personal computers. Then came the internet. Then mobile computing. And eventually, cloud computing. Each wave rewarded companies that could move quickly and adapt to changing customer needs. IBM, however, was built for a different era. An era where technology decisions were made over years, not months. Where stability mattered more than speed. Where large organizations preferred proven solutions over constant innovation. For a long time, that model worked exceptionally well. But as the industry accelerated, IBM found itself struggling to keep pace. While new technology leaders were building the future, IBM was often focused on protecting its past. Revenue growth slowed. Investor confidence weakened. And competitors increasingly became the face of innovation. By the late 2010s, many people no longer viewed IBM as a technology leader. Instead, it was seen as a company trying to rediscover its place in a rapidly changing world. The question was no longer whether IBM had been successful. That was beyond dispute. The question was whether IBM could reinvent itself before it became irrelevant. And that question would ultimately lead to one of the boldest decisions in the company's history. By 2019, IBM faced a difficult reality. The company was still profitable. It still served many of the world's largest organizations. But investors were increasingly questioning its future. Revenue growth remained inconsistent. The cloud market was expanding rapidly. And IBM needed a strategy that could restore its relevance in a changing technology landscape. Then came one of the boldest decisions in the company's history. IBM announced it would acquire Red Hat for approximately $34 billion. At the time, it was one of the largest software acquisitions ever completed. The reaction was mixed. Some investors believed IBM was overpaying. Others worried the company was taking on too much risk. After all, $34 billion was an enormous bet for a company already struggling to convince the market that it could return to sustainable growth. But IBM's leadership saw something that many investors overlooked. They believed the future of enterprise technology would not belong to a single cloud provider. Instead, they believed large organizations would operate across multiple environments. Private clouds. Public clouds. Legacy systems. And new applications. The challenge would not be choosing one platform. The challenge would be connecting them all. And that is exactly where Red Hat excelled. More than an acquisition, Red Hat became the foundation of IBM's transformation strategy. The company wasn't simply buying revenue. It was buying a new direction. A direction that would shape IBM's future for years to come. To understand IBM's strategy today, we first need to understand how large enterprises actually operate. Many organizations don't start with a blank sheet of paper. They have decades of existing technology, applications, databases, security systems, and critical infrastructure that cannot simply be moved overnight. For years, the cloud industry was often framed as a simple choice. Move everything to the cloud. Leave old systems behind. But for many large enterprises, reality proved far more complicated. Banks still relied on mission-critical systems. Governments faced strict regulatory requirements. Healthcare organizations managed sensitive data. And multinational corporations operated technology environments built over decades. For these organizations, replacing everything wasn't practical. And in many cases, it wasn't even desirable. Instead, they adopted a different approach. They kept some workloads on private infrastructure, moved others to public clouds, and increasingly operated across multiple cloud providers at the same time. This became known as hybrid cloud. And IBM believed this would become one of the most important trends in enterprise technology. Rather than competing to become the largest public cloud provider, IBM chose a different path. The company's goal was to help customers manage complexity. to connect old systems with new applications, to integrate different cloud environments, and to allow enterprises to operate across all of them more efficiently. In other words, IBM wasn't trying to own the cloud. It was trying to help customers navigate a world where no single cloud could do everything. And if that vision proves correct, IBM may be positioned in one of the most valuable parts of the enterprise technology ecosystem. When people think about artificial intelligence, IBM is rarely the first company that comes to mind. The conversation is usually dominated by companies building the most powerful models, the fastest chips, or the most popular AI applications. And that's exactly why many investors dismiss IBM's AI ambitions. But IBM isn't trying to win the same race. The company's strategy is built around a different question. What do large enterprises actually need from artificial intelligence? For most organizations, the challenge isn't simply generating text or answering questions. It's integrating AI into existing operations, managing sensitive data, meeting regulatory requirements, and ensuring that AI systems can be trusted in real-world business environments. This is where IBM believes it has an advantage. Through its Watsonx platform, IBM is focusing on enterprise AI rather than consumer AI. The goal is not to build the next viral chatbot. The goal is to help businesses deploy AI across their workflows, applications, and decision-making processes. And for large enterprises, reliability often matters more than novelty. A bank, for example, may care less about having the most advanced model in the world and more about ensuring that its AI systems are secure, explainable, and compliant with regulations. The same is true for governments, healthcare organizations, and many of IBM's existing customers. This creates an opportunity that looks very different from the AI race dominating headlines. While others compete for consumer attention, IBM is positioning itself to help enterprises adopt AI at scale. Of course, success is far from guaranteed. Competition remains intense. Technology evolves rapidly. And enterprise adoption may take longer than many investors expect. But IBM doesn't need to become the biggest AI company in the world to benefit from artificial intelligence. It only needs to become a trusted partner for the organizations already relying on its technology. And if AI becomes deeply embedded across enterprise operations, IBM may find itself in a stronger position than many investors currently believe. In technology, competitive advantages often seem obvious. A superior product, a dominant platform, or a powerful network effect. IBM's moat is different. And that's one reason why many investors overlook it. The company's greatest strength may not be a specific product at all. It may be the trust it has built over decades. Many of IBM's customers are not small businesses experimenting with new software. They are banks processing millions of transactions every day. Governments managing critical public services. Healthcare institutions handling sensitive information. And global corporations running complex operations across multiple countries. For these organizations, technology decisions are rarely based on features alone. Reliability matters. Security matters. Experience matters. And trust matters. Over decades, IBM has built relationships with customers whose operations cannot afford major disruptions. Once technology becomes deeply integrated into critical workflows, replacing it is rarely simple. A company may be able to switch a productivity tool in a few weeks. But replacing systems connected to core business operations can take years. The costs are not only financial. There are operational risks. implementation challenges, employee retraining, regulatory considerations, and the possibility of disrupting systems that businesses depend on every day. As a result, many organizations choose evolution over replacement. They modernize existing environments rather than rebuild everything from scratch. And that often plays directly into IBM's strengths. This doesn't mean IBM's customers can never leave. Nor does it guarantee future growth. But it does create a level of resilience that many technology companies would struggle to replicate. Because while products can be copied and technologies can change, trust built over decades is much harder to replace. And in enterprise technology, that trust may be one of the most valuable assets a company can possess. When most people hear the word mainframe, they imagine a technology from another era. Something outdated. Something destined to disappear. Something that should have been replaced years ago. And yet, mainframes remain one of the most important parts of IBM's business. Why? Because the world still runs on them. Every day, banks process enormous volumes of transactions through mainframe systems. Airlines manage reservations and operational data. Insurance companies handle claims. Governments process critical records. And many of these workloads demand something that is often overlooked in technology discussions. Reliability. For these organizations, downtime is not merely inconvenient. It can be extremely costly. In some cases, it can disrupt essential services relied upon by millions of people. That is why many enterprises continue to use mainframes for their most critical operations. Not because they resist innovation, but because these systems have proven capable of handling massive workloads with exceptional stability and security. What's particularly interesting is that modern mainframes are not frozen in time. They continue to evolve. Today's systems support cloud integration, automation, and increasingly, artificial intelligence workloads. In other words, the choice is not always between old technology and new technology. Sometimes the future is built on top of infrastructure that already works. For IBM, this is important for another reason. Mainframes generate high-value revenue through hardware, software, and ongoing support services. They remain deeply embedded within industries where reliability is non-negotiable. As a result, what many investors see as a legacy business may actually be a strategic asset. Not because mainframes represent the future of technology, but because they continue to play a critical role in the systems that power the modern economy. And as long as those systems remain essential, mainframes are likely to remain relevant as well. Throughout this analysis, we've explored IBM's transformation. Its shift toward hybrid cloud. Its focus on enterprise AI. Its long-standing customer relationships. And the role of its mainframe business. But none of these strategies matter if they fail to produce one thing. Cash. Because in the end, cash flow is what turns strategy into reality. It funds innovation. Supports acquisitions. Strengthens the balance sheet, and gives a company the flexibility to adapt as markets evolve. This is one of IBM's most underappreciated strengths. Despite years of restructuring and transformation, the company continues to generate billions of dollars in free cash flow. That financial strength allows IBM to invest in its future without depending on constant access to outside capital. For a company reinventing itself, that matters. Transformation is expensive. Developing new software requires investment. Building AI platforms requires investment. Integrating acquisitions requires investment. IBM can pursue these initiatives because its existing business continues to generate the cash needed to fund them. In many ways, IBM's legacy businesses are financing its future. That doesn't mean every dollar of investment will produce strong returns. Management still has to allocate capital wisely. And investors should continue evaluating whether these investments create long-term value. But the ability to generate consistent cash flow gives IBM something that many companies in the middle of a transformation lack. Time. Time to execute. Time to improve. And time to prove that its strategy can deliver sustainable growth. For long-term investors, that may be one of the most important indicators to watch. Because successful transformations are rarely funded by optimism alone. They're funded by businesses that continue generating real cash while building for the future. Every turnaround story comes with uncertainty. And IBM is no exception. The company's strategy is clear. Its direction makes sense. But success ultimately depends on execution. The biggest challenge is not whether IBM has identified the right opportunities. The challenge is whether it can grow fast enough to convince the market that its transformation is working. Enterprise technology moves slowly. Large organizations take time to adopt new platforms. And while that can create stable customer relationships, it can also delay growth. Competition adds another layer of uncertainty. IBM is competing in markets where innovation never stops. Cloud infrastructure. Enterprise software. Artificial intelligence. Each of these industries includes companies investing tens of billions of dollars every year. IBM doesn't have to beat every competitor. But it does need to prove that it can continue creating value in an increasingly competitive environment. There is also the challenge of perception. For more than a decade, many investors viewed IBM as a company in decline. Changing a business is difficult. Changing the market's opinion can be even harder. Even if IBM executes its strategy successfully, recognition may take years. That creates an important risk for investors. Not that IBM fails overnight, but that the transformation takes longer than expected. And in investing, time matters. Because the longer a turnaround takes, the greater the chance that new technologies, new competitors, or changing customer priorities could alter the outcome. None of these risks invalidate the investment thesis. But they do remind us that transformation is never guaranteed. And before deciding whether IBM is an attractive investment, there's one final question we need to answer. Has the market already priced in these risks? After examining IBM's business, one question remains. Has the market already priced in everything we've discussed? This is where investing becomes more challenging. Because a great business is not always a great investment. And an average business can sometimes become an excellent investment, if it's purchased at the right price. So rather than asking whether IBM is a good company, we should ask a different question. What expectations are already reflected in the stock price? Today's market recognizes many of IBM's strengths. Its recurring enterprise business. Its consistent cash generation. Its leadership in hybrid cloud. And its growing focus on enterprise AI. At the same time, investors remain cautious. Growth has been modest. Competition is intense. And many still question whether IBM can deliver a sustained turnaround. As a result, IBM is often valued very differently from many of today's high-growth technology companies. That difference raises an important possibility. If IBM simply performs as the market expects, today's valuation may already be fair. But if the company's transformation proves more successful than investors currently anticipate, the market's expectations could change. And when expectations change, valuations often change with them. This is why valuation is never just about financial ratios. It's about understanding the gap between expectations and reality. So before reaching any conclusion, we need to answer one final question. Based on IBM's future cash flows, what is the business actually worth? Let's find out. After examining IBM's business, its strategy, competitive advantages, cash generation, and the risks it still faces, we can finally estimate what the company may be worth. Rather than relying on a single outcome, I prefer to value IBM using 3 different scenarios. The first is a conservative case. This assumes slower growth and more cautious market expectations, resulting in an estimated value of approximately $213 per share. The second is the historical case. Here, IBM performs broadly in line with its long-term operating trends while continuing to execute its transformation strategy. Under these assumptions, the estimated intrinsic value is approximately $296 per share. Finally, there's the optimistic case. If IBM successfully accelerates growth through hybrid cloud, enterprise AI, and continued software expansion, the estimated value rises to around $360 per share. Among these scenarios, I believe the historical case provides the most balanced view of IBM's long-term potential. It recognizes both the company's strengths and the challenges that still remain. Based on this analysis, my estimated fair value for IBM is $296 per share. Of course, valuation is never a prediction. It is simply a framework built on assumptions about the future. And those assumptions can change as the business evolves. That's why the most important question isn't whether this number is exactly right. It's whether the market is currently pricing IBM below, near, or above its long-term intrinsic value. That difference is where investment opportunities are created. Over the course of this analysis, we've seen 2 very different versions of IBM. The first is the company many investors remember. A technology giant that lost momentum as the industry changed. The second is the company IBM is trying to become. A business centered on enterprise software, hybrid cloud, artificial intelligence, and long-term customer relationships. The investment thesis depends on one key assumption. That IBM's transformation will create more value than the market currently expects. The company doesn't need to become the fastest-growing technology business. It doesn't need to dominate consumer AI. And it doesn't need to win every battle against larger competitors. Instead, IBM simply needs to continue doing 3 things well. Growing its software business, expanding enterprise AI adoption, and generating the cash flow required to reinvest in its future. If management executes successfully, today's valuation may underestimate IBM's long-term earnings power. If execution falls short, however, the market's current skepticism could prove justified. That is the balance every investor must consider. Because investing is rarely about certainty. It's about weighing probabilities. For me, IBM isn't a story about chasing the next technology trend. It's a story about whether a forgotten technology giant can create steady, long-term value through disciplined execution. And perhaps that's the question the market has yet to fully answer. As always, this video is not financial advice. Please do your own research before making any investment decisions. Thank you for watching, and if you enjoyed this analysis, don't forget to like, subscribe, and share your thoughts in the comments below.